Yesterday's video, it was about what actually changed in the budget. So what I want to do today is just talk about a few little points I noticed in the budget commentary. Now it's all out there and it can be analyzed in detail. And then I'm just going to talk about some of my thoughts on the tax planning and how that's going to change, and also really some of the risks to the economy because of it. This year, whilst this might be the worst budget I've ever seen, as an accountant, it's been easier to analyze than any budget I've ever seen. And I think the OBR League just really helped. Normally, watching a chancellor deliver the budget in slow motion is like pulling teeth. Like, the OBR just offering all of the key points up in one document was a godsend. So whoever the OBR did that is a national hero, in my opinion. But actually, this is a really good point about leadership. Rachel Reeves and the cabinet, they created a culture of leaking stuff. And then when they didn't want stuff to be leaked, it continued getting leaked. So if you are in any kind of leadership position, don't underestimate the importance of leading from the front, doing the kind of things that you expect your subordinates and people who look up to you to be doing themselves. So it's a prime example of that. What's quite a sort of funny point from the budget at the moment, but there was the last budget, October 24, it brought in a piece about regulating tax advisors. I was really looking forward to this because I think there's too many unregulated accountants out there and businesses are suffering because of it. We have voluntary regulation, but this was about bringing mandatory regulation into the industry. And unfortunately, yesterday's budget has removed that. And there was a statement from that budget that says the government's not going to pursue the mandatory regulation of tax advisors anymore. What is interesting is HMRC today released a statement saying the mandatory regulation of tax advisors is going to come in May 2026. Do they know something Rachel Reeves doesn't? It's probably a good thing the government isn't trying to regulate tax advisors, maybe because they don't really understand tax themselves. My thoughts on some things that we need to start doing from yesterday's budget is the salary sacrifice cap is going to come in April 2029. This is disastrous, really, because what it means is there's pressure on employees and business owners to put every spare scrap of money they have into their pension for April 2029. What that means is people just are going to invest in the growth of their businesses. What they're going to do is just try to prioritize getting as much cash into that pension as possible before the punitive national insurance charges come in on pensions. So my tax planning point here is you should always attempt to grow your business because there's loads of reasons you do need to grow your business. For example, to keep up with inflation, to make sure good quality members of staff have growth in their salaries and the work they do. Also to build up a buffer in case times are bad. Ultimately, this is going to be a huge disincentive to grow a business because people will just need to try and get every scrap of cash into this pension. So if you're thinking of doing some financial planning, one thing to really understand is how far back can you carry your pension allowances? You've got 60,000 a year at the moment, which you can put into a pension via the salary sacrifice method. That goes back 3 more years as well. So I think it's 60 the year before, and then 40 the year before that, and 40 the year before that. And then you've got another, I believe, 3 or 4 years until, or let's call it 3.5, until the new rules come in. In theory, there's probably a good £400,000 you can get into your pension if you haven't used those allowances by 2029, if you just get the timing and utilize them correctly. And then after that, then really the right thing to do is then probably ease off from what you contribute to the pension because you front loaded it. But that's one tax planning point to think about. I do think as a business owner, it'll be different for employees, but as a business owner, you probably won't end up paying the national insurance anyway, because you probably find it makes more sense to take more money out of your business as dividends and then contribute into the pension privately instead of via your business. Although then there is a cap in terms of how much you can do that because it's limited to the amount of salary that you take, and it can't be greater than the amount of salary that you take. But that's definitely one point. In yesterday's video, I made a few comments about the rise in dividend tax. And I said, figure out if you're better off taking a salary. Another point to it is figure out if you might want to unincorporate. A lot of businesses can't do that because they have to be limited companies for various reasons. And also, if you've got a good quality limited company with trading history, you might not want to give that up, although you could potentially make it dormant. But for some people out there, it might actually just make sense being a sole trader. If you do something that's relatively low risk and your income is relatively low, then it doesn't necessarily hurt to be a sole trader. So it's worth considering. You probably can't go down that route if you have a team, because that's risky. If you will have restrictions on company cars, certain training costs. There are downsides to being a sole trader outside of not having that limited liability, but it might be worth considering. Yeah, so yesterday in the video, I did allude to a reduction in capital allowances. So I just want to elaborate on that a little bit more. At the moment, by the way, and I'm going to elaborate on this by saying I don't think it's really going to affect many small businesses, and I'll explain why. At the moment, you have what you call tax depreciation. And typically, if you buy something, you've got two options. It might qualify for annual investment allowance, which is usually the preferred method. And then you can put all of it through in the first year as if it was an expense. Even if that asset is going to last you a few years, you just treat it as if you just paid for it in the first year and get the entire tax deduction in that first year. However, certain things in a business that you buy that don't qualify for annual investment allowance, you then will need to then depreciate it, use tax depreciation, which is what we call writing down allowances. Those writing down allowances, typically, I think they've been 7% or 18%. There's a couple of different rates. And the headline rate is 18%, but they're actually reducing that to 14%. What that means is the amount of tax depreciation that you can claim to lower your tax bill is reducing by 4% on whatever you're depreciating. Now, this is why it's actually not going to really impact small business owners, because the vast majority of stuff that a small business buys will qualify for annual investment allowance. But the only time it will really impact the limited company owners is if you're buying a second-hand electric car, because brand new electric cars, they do qualify for annual investment allowance. So you just put it through all in 1 year, and there's been no changes to that so far. But if you bought a second-hand electric vehicle, you will find that the amount of depreciation you put through every year on that will now reduce from next year. Did talk about my frustrations around national minimum wage outstripping inflation. My additional points to that are businesses really need to just do a bit of research to understand how much their costs are going up by, so they can then be proactive about passing the price increases on. This is one of the biggest issues we're seeing with clients at the moment. They're getting caught out by not putting their pricing up, and then suddenly their profit just disappears. And we're working really hard to educate them on this. But just bear in mind, if minimum wage goes up, inflation goes up, really the ISA thing, yesterday, maybe I was a bit cavalier about it, and I said I don't really care about cash ISAs. Let me put a bit of context on that. I'm not a financial advisor, so you should definitely talk to a financial advisor about this. But there's a lot of good quality index funds and also bond indices as well, where you can just buy one share in something and it contains like a portion of shares in 3,000 companies, 1,000 companies, the FTSE 100 and FTSE 250, the S&P 500. My pet fed one, the PSWR. But these are all funds you can buy through a stocks and shares ISA. So unless you're really just about to come up to retirement, you really need somewhere to put your cash where it's safe as houses, then you should really consider that stocks and shares ISA. But remember to talk to a financial advisor. Okay, all right, thank you. I'll see you at the next video.